Good afternoon, everybody, and welcome back to our StockTwits Q&A session. I'm your host, Brittany Umar, joined by Scott Red Dog Rather. We're going to be answering your questions live. Scott, you ready to tackle some today?
Yeah, I think, first of all, everyone, welcome back. I know that today was one of those days where everyone probably would rather be at happy hour and relaxing because of the whipsaw action that we've seen today, the back and forth action we've seen all week ahead of what could be a very eventful weekend coming up. So, we just want to get right down into the nitty gritty. Everyone has a lot of questions on how they should be positioned, what type of risk could they put on, how to handle themselves. So we're just going to go right into it. So what's the first question, Britt?
Yes. Well, speaking of that action that you're talking about, we have one right off the bat from Shady Capital saying the market has been a chop fest as of late. What are some rules a trader can implement to prevent over trading?
Well, there's a lot of questions in there. First of all, it's been a chop fest because the market's been trying to figure out what the next direction is. We had a pretty significant correction, right? 10, 11% off the highs. In a normal world, that probably would be enough. But we're in far from a normal world when you're hearing news about the ECB and the central banks coming in to potentially provide liquidity like that impulses rally today, just in case Greece vote goes against the bailout package, this and that. So all in all, a lot of technicals have indicated that we should be bouncing or we can continue higher, but there's that geopolitical or there's just all that headline risk out there, so it's been tough. So we say less is more. We say control your risk, know what you have defined. And if you look at the pattern here, the pattern has given us at least some resistance that we could trade against and some support. So a lot of guys out there, first just real quickly to go over this pattern. We talked about this head and shoulders pattern so many times. The left shoulder, the head, the right shoulder. When it broke, gave us this nice measured move. And then recently we talked a little forward looking about the inverted head and shoulders pattern. Here's the left shoulder, here's the head, and here's the right shoulder. Within this pattern also, we had a pretty significant move off the lows. Remember, we broke through the 200-day, got guys out late who missed a lot of the sell signals from when we broke this upper area or broke the neckline or continued lower. A lot of guys fearfully, which you never do, which is one of my rules, not to sell into fear or obviously buy excitement. So anyway, traded below, regrouped, and then it was very important to see what would happen over here. We basically held, which Laz later will probably go over the Fibonacci numbers because he's so good at giving you the roadmap, the upper third of this range, showing some commitment to this move off the lows. So recently, everyone's been very frustrated right in this area. So if you want to take a closer look here, rightly so, this has been this very, very tight range, okay, with the low here, which I've been tweeting about all the time, saying, let's dummy it down. Let's not worry about the world problems and whether we have solutions to them. All you know is that if we continue to hold this 1307 to 1310, there's a decent chance we could trade above this resistance of about 1327, 1330 for a move to the upper moving averages, which are now right around this, I would say closer to 1355 to 1358. That if you have a short thesis and you think no matter what, the world's going to fall apart, the problems in Europe aren't going away, you better be able to hold through if you're just holding intermediate shorts. But those uncommitted shorts, if you were short versus area, you probably covered a little bit today. Okay, and if you wanted to potentially, get long for a continuation after absorbing a move off the lows, today was one of those days that, maybe it takes some long, even though we do have some headline risk. And at this point, we haven't had 2 days in a row in a while. Let's see if tomorrow we get a little follow through, because right now follow through has been very hard to come by.
Now, Inwood123 says he keeps hearing the markets are pricing in a QE3 or twist. So might this mean a sell the news next week?
Well, it all depends. If we close up tomorrow and then we gap up on the news out of Europe or QE news or whatnot, and we're at, just say on the chart here, 1358 to 1360, which is another resistance area, that could be a sell the news. Why not, right? That would be a retest of this broken neckline. That would be pretty symmetrical and a nice little trade here. So if we could, close up a little bit tomorrow, gap up into this resistance, that would be a decent fade. And as an active trader, that's probably what we would do. If you look at the spiders, same type of scenario, we just started to poke our head above this downtrend line and almost got back even to where we reversed, on June 11th. This would be probably an area that if we gap up into on some type of Monday, phenomenon, I think that would be a nice calculated short. So at this point, you don't want to think too far ahead. what I like to do is have like resistance 1, 2, and 3, support 1, 2, and 3, see how we get there, and then let the market confirm your strategy. And right now it looks like we're trying to break above resistance, whether you believe in it or not, or whether you think that it's being manipulated. You know, who are you to think that way? Because who are you to say what the market's supposed to do? We're traders. We let the market confirm action. We let the price dictate movement. And at this particular point, it's trying to break above. If you don't believe in it, then don't be involved or do a little bit less. I don't particularly believe in it, but I'm going with it with a little bit of money involved because that's what I do. I am by no means all in. I'm by no means in tier 2, 3, or 4 in anything, but we're breaking above it. Good book says be a little long. If we, gap down tomorrow, then I'll salvage a trade and figure it out from there.
Now, we've gotten a lot of questions on Apple, so let's tackle some of those. The Finisher is asking for your thoughts on whether commitment has been shown post-Apple's May 21st reversal.
Apple lately has been a little frustrating, but if you look at the macro chart, I think that it's still holding in fine, right? You had the S&P get down to the 200-day. You had a lot of indices break it. Apple came all the way down to the 100-day and held. 200-day all the way down here, so that shows me relative strength. So this was one area that some guys put on as a swing trade when it held the 100-day and reclaimed this lower pivot. And then since then, if you had your stop at this low, you've been holding it and you haven't been micro trading and you haven't been involved in the noise, so that's fine. If you look here on the macro, pattern here, you do see somewhat of an inverted head and shoulders pattern too, where you have the left shoulder, the head, and then the right shoulder somewhat. It tried breaking above it the day of the conference and the event and the news, and they sold it. So that was actually a great short for those who are looking for a push through failure, and that's what it did right there. Push through, failed. So there was no momentum. You had to get out of the way if you were trying to add a tier size to potential this reversal. And then the day after was a decent tactical short when it traded below 570.63, then a tactical long, and right now it didn't really participate in today, so you have to be a little bit on edge or not all in, but I still think it's doing some basing action. And if the market gets a green light to continue higher, whether it's the news out of Greece or the stimulus package, the bazooka, whatever it is that they label as the catalyst, the next area for it to really get above, and where shorts that are trying to short against the level, they'll probably be covering around 579, 581. And then if it continues, that'll give some energy to the market and it'll be a nice trade. But right away, a macro investment, you stay in Apple. As an intermediate trader, if you got in here for a swing, you're still there. As a micro scalper, if you're flat, just trade against this 579. If it breaks above on some volume, it could get a bit more interesting.
Now we're getting questions from Market Picker and Audubon, both asking about Nike and Lulu. Of course, both stocks closing below the 200-day moving average today. So what do you think?
Well, you never want to really sell on them when it breaks below the 200-day. If it's at the 200-day, it probably showed you a few signs along the way that you could have sold some stock or got a little bit lighter, because there's always faulty signals, whether you have a false breakout, whether it breaks even like the 50-day, the 100-day, breaks an uptrend. So whenever it breaks the 200-day, it's always an event that you have to take notice, and you never really want to see it happen, because if it loses the 200-day and doesn't reclaim it in the next 2 sessions, typically, because sometimes it breaks it, it's a trap, comes back above, and then you're okay, and they get out everyone just like in the market. Remember, broke below the 200-day, I said the market needs to reclaim that in the next few days, otherwise, we're in trouble. But if it does, take notice. And real quickly, just to show you here, that's what happened. It broke below the 200-day, got people who missed a lot of these sell signals out of the way, and then reclaimed it, and now look where we are. So if you go to Nike, Nike is also a rule or a lesson to show you that trends change and you're allowed to have upper level stocks and use your tier system, because look what happened here. Anytime you see a false breakout, okay, that is a sign of distribution. That is almost like it's an outside event. Even though it didn't take 1 day, it took 3. That's something that says, something might have changed. So you sell some, especially if you were trading it for momentum. Once you trade for momentum and momentum leaves, that's definitely a sell signal. So that right there was your sell signal. And then if you look at your upper level, trend line here, it broke below, retested the longer term trend line back from August, and and bounced off it. And then once it couldn't reclaim it, if you missed this sell signal, if you missed that sell signal, this was your way out. And then PS traded lower. Now you have a high, lower high, and now it just accelerated to the 200-day. So at this particular point, If you held through the whole thing, do you sell here? It's a little complicated because you missed a few of the sell signals. I would say if you didn't sell it yet, maybe put a stop at the low of today, 96.36, or put a stop, and if it reclaims it and you see some kind of pivot low, maybe rebuy it back and use that as your stop. But if it can't bounce back and get back above this next resistance about 104.84, it could continue lower. Okay, these stocks change complexion. You guys remember Google? A lot of you guys talked about Google, and in the beginning of the year, I was like, look at this pattern here. This could be high beta tech stock of the year. And then they misfired on 2 earnings reports, and then it was hovering at the 200-day. And I said to everyone, listen, maybe it's not the stock of the year. Who cares? We trade real time. It's not acting well. They haven't delivered. If it breaks the 200-day, macro investors should sell some or get out of the way. And if you look at Google right here, it also aligned with a pretty big support, broke the 200-day, because that's what it was at the time. That was the lowest moving average, 596. If you didn't sell, look, we talk about breakout failures. Remember this one? Okay, here you had a breakout failure. You don't want to see that. Last time we really liked it was right here in the beginning of the year. Tried to break out, came right back, didn't hold higher. So that was a breakout failure that led to lower prices. Here was another breakout failure that led to lower prices. So again, the question's about the 200-day. It broke the 200-day, couldn't get back above it within a few sessions, so it didn't prove to be a trap, and now it's all the way down. Today the low was 556, about, 40 points lower than 596. You could have saved yourself 40 points, and then you could have also been looking for a better entry. And right now, hopefully you're not trapped in this, and hopefully you're looking for a better entry because maybe there are better times ahead. But for right now, Google's on its way lower. And just to finish off this question, Lulu, another rule here, okay? We thought Lulu's been a darling. It's been making guys a lot of money, for a while if you've been riding it. Oh, what a coinky dink. You had a breakout failure, right? Another breakout failure where it tried to go, came back in, sell signal number 1. And then, it came out with the bad earnings. Came down, and basically no one came in to buy this gap fill. So that showed you that this pro gap will control direction. So if you didn't get out on earnings day, the day that it tried to push through and closed on the lows, which was right here, this was an outside day, that was your sell signal. And then since then, guys have been making money short. So the question is, do you sell it here at the 200-day? It's always a hard sell if you miss some of your other opportunities. So at this point, if you're still there, I would say use today's low as a stop. It's right in front of a big gap. There should be some bulls that try and protect it, but I do think that you have to be very careful that some stocks come to an end. It has a big PE. It's been on a long road for all the way up here, and just I would just make sure, same way you have lower level stops, have high level stops, and if they don't reclaim their 200-day very quickly, then you just have to sell it, lick your wounds, or give back some of the profits that you probably shouldn't have given back so much of, and move on.
So if we get the resolution to the upside in the SPX, what are some leading stocks you would be looking to buy? Market Picker asks if it would be stocks like Dollar Tree, Dollar General, Family Dollar Stores, Expedia, Verizon, AT&T, Dunkin', a lot of names there.
See, that's the problem with this move right now, because I've been trying to come up with reasons why we would break above it, what stocks I can go to and hold a portfolio of names, and they're all different names that I'm used to. Even today, the market was strong. Google was down, Apple was down, Amazon was down, the casinos were non-events, banks were like and you had like some of these other stocks leading the way. So at this point we break above, I don't see stocks ready to break out. But if you look at a stock like you said, what, Dollar Tree, this stock looks really good. It looks like it's at highs, but are you going to initiate a new position at new highs? No. This was your spot to have initiated a position right when you had a nice pattern here, when it broke above this downtrend or this pivot area, and pow. So I don't think you should be initiating today. Verizon, you want to talk about another stock? You're late. You're going to be chasing this thing. This was the time that you should have been buying Verizon. Here's your nice base. It broke above this pivot area above 41.91, and so you're going to start chasing up here. It was even good today. So I don't think that they could extend because they've been strong, but you missed your pivot area. So at this point, I don't know exactly where to go. So that's why I'm going to do a little less. I'll stick with some of the indices, and I'm just going to get and wait for more clarity, because it's still only second week of June and we have a lot of summer left.
Okay, well, speaking of doing a little less, this is a perfect follow-up to that. DBQ saying, when you say less is more, do you really trade less, or do you still trade but expect a smaller profit?
You do both. Okay, where back in the first quarter I was holding like 13 to 14 positions, and I was in tier 2 in some, tier 1 in some. A good day then was different than a good day now. And it's always a little relative. So, then I might, I'm not going to put numbers on it, but holding 13 stocks on a big up day, you make a lot more money than, you trying to create cash flow in a choppy environment, trading 1 and 2 stocks. So you have to lower your expectations. So you have to have better money management skills. If you're on my virtual trade floor, you've been seeing that I'm really not doing much. I'm trading 3 to 4 stocks versus 10 to 15, like when we're in a better trending tape. Maybe that changes. Maybe we start getting back in a trending tape. But at this point, when you have low volume, you have uncertainty out there, you don't want to lose too much because it's a lot harder to make it back now. What you want to do is just tack a few green days together. Make this month a positive month that adds to your year, but it's not going to be your rock star moment. And there are better times when there's more clarity, when you could sink your teeth into things. And right now, I don't think that's the time.
Well, here's another strategy question for you then. Level 2 asks, do you prefer entering stocks at predetermined price ranges or watching the intraday chart for setups regardless of price?
I think both. I think when they combine, that's when you get into more than a tier 1 or a tier 2, or maybe even a tier 3, like, so to speak, Facebook today. Facebook, I know it drives everyone to drink and it's Thursday, so go out for happy hour and have a few. But the predetermined price was really 28.10 because 28.10 has been the high of the move. So it wasn't really a tight chart pattern, buy price, but that's a pivot area that he says, okay, if it's acting well intraday and if you think there's going to be continuation, that's a spot that you're going to, have action with. But intraday, it also showed today a little relative strength. So if you go to Facebook, Facebook today, you go here, the predetermined price that my traders were watching, which they also learn about in the active course, is when it breaks above pivot points. And right here, 28.10 was a pivot price. So right there, even though it's not that tight and it's, it is what it is, that was a price. But if you go to your 5-minute chart, and then you see this, first you see this nice tight pattern right here where it's intraday, it gapped up, never filled the gap. So it was the first time in a while it showed a little commitment, and then it was tight all afternoon. This could have been your first buy right here. Okay, so your tier 1 buy was when it went above the high of the day at 27.97, and then your tier 2 buy was when it cleared 28.10, and then maybe you sold the tier on the close because you didn't want to have so much overnight exposure. So you made 20 cents on this price if you sold on the close because that's where it was, but then you're also still holding a tier 1 from here. So you made 30 cents on this, 20 cents on that, you book some profits, and then you take some for what could be some continuation above this level to potentially, who knows, maybe you could see 29.67 or maybe even this other pivot that we closed below.
All right, well, we are going to take a quick commercial break, and then we're going to be joined by Evan Lazarus, who will offer another point of view. Keep the questions coming, guys.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders to understand how to develop an edge in the markets so you can put your money to work with confidence. The T3 Live approach includes a mix of training, trading, and technology to help you learn to recognize, adapt, and ultimately take advantage of different market conditions. So what actually separates T3 Live from other educational firms? For one, transparency. We show all of our positions live, so there is no smoke and mirrors. Basically, we put our money where our mouth is. We have to because we're regulated by the SEC and the Chicago Board of Exchange. Number two, we're real traders. You'll be learning from real professional traders that make a living trading their own proprietary trading accounts, not just instructors that don't trade. Your goal should be to associate and learn from big traders who can teach you how to take your trading to the next level. And three, credibility. Millions of people turn to places like CNBC, Wall Street Journal, Fox Business News, and these outlets actually look to T3 Live for information. No other educational firms are asked to be a consistent contributor. We at T3 Live would like to get you started with a step-by-step method that has been proven over time. The same blueprint for success that I've gone through. It's not a weekend seminar, it's an approach, a mindset, a process to show you how to take control of your financial future. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our Foundation 30-day online home study course. The reason I'm willing to give you such a valuable course for free is I'm sure that once you complete the program, you'll want to continue your education with our team. All you have to do is fill in your name, email address, and I'll see you on the other side.
We're back and we're answering your questions live. This time I'm joined by Evan Lazarus. Laz, Scott just offered his insight on playing Facebook, but we just got another question in, so maybe you can tackle it and offer your viewpoint. Broker Bryce saying, with limited data on Facebook, what's the best overall way to trade it?
There's two trades right here. The trade is, to not do anything. That's a trade. Cash is a position. From the get-go, the stock hasn't shown us anything to really sink our teeth into from trying to buy it. If you've been trying to buy it, you're basically bottom fishing, that type of trade rarely works. Maybe 1 out of every 20, and it's not a profitable strategy, not something we ever teach or talk about. Being a buyer here requires some basing action, which is what you're getting. I like Facebook. For the first time, I'd say I like it. I say that very mildly and tepidly. It's still not a great long. It's found a bottom at 25.5. It's grinded its way back to 28 and change. First time above the 8-day, which is the blue line you see here. That's the only reason I'm starting to like it a little bit more. I think the trade is not going to be fast and furious to the upside. It could run into prior pivot here, just around $30, but it's not great risk reward. If it does break this, little base that it's been in, you can look at a 60-minute here. If it does break below this base with some volume attached to it, that could speak to lower prices here. So it's not a trade that I would go heavy in. If you wanted to trade against the lows and be tier 1, it's starting to come around. But again, it's not a trade that I would even put into the A or B category yet.
All right, well, we know Facebook has caused people a lot of pain out there, and Big Ponzi wants to know, Laz, what's the worst trade you ever made and the best?
Big Ponzi, I like that. Let's see, the worst and the best trade, I have to think. I'm going to say the best trade hasn't happened yet, because then I essentially have nothing to look forward to.
I like that attitude.
If I've made good trades, I've made great trades, but hopefully my best trade is yet to come. It gives me something to work for and something to look forward to. As far as the worst, there have been some stinkers. Trying to think of the worst. Yeah, there was a day in Apple. I got caught on the wrong direction, and it was pretty punishing. I've never really taken massive losses, the kind that would end a career, or the kind that you can't recover from. So I guess I'm fortunate in that regard. But I have had my handful of kicks in the butt, and I think every good trader, that I know that has achieved any success has gotten there because they know how to get out of a sticky situation, or they've been beaten down and they realize that they have to fight their way back little by little by little. Whenever you get into a bad trade, you have two choices. You can roll over and play dead, or you can get up, brush the dirt off your shoulders and start to slowly claw it back little by little by little by little by little. And over time, it's just something that happens in the past. As far as the worst trade goes, I really, in all honesty, don't remember anything being the worst, but there have been a few, really not pretty trades.
Well, Don Francisco says, Laz, you always talk about the story of a stock. What does that mean?
The story of a stock is basically understanding the language of price. As a trader, a technical trader, we study price. That's all we look at. We look at trends, and we look at moving averages, and we look at candlesticks, and we look at all these different visual, images that speak to us about what's happening. Where is the path of least resistance? Is the stock, setting up for higher prices? Is the stock setting up for lower prices? By understanding the story, it's really, it's looking at the whole picture, which is, for lack of a better word, the daily chart. This is the macro. This is what's happening over the last 3 months, 6 months, the last year. And then we break it down and we look at more detail. We look at more granular information. And we go to our 55-minute chart or our 60-minute chart. And you look at what's happened over, let's say, the last 10, 15, 20 days. So you can really evaluate the here and the now. Do you see any patterns developing in that time frame that can potentially lead you to believe that this stock is going higher or going lower? So for instance, when we look at the daily chart, and I'll use Apple here as an example, we can put it up. What you see here is, lots of ebbs and flows. You have a flat 21 EMA. I've talked about this before. It's a trendless stock. And from this time frame, it doesn't really tell you a whole lot of information about, higher or lower. So it's hard to get a good idea of, is there a story here? But as you go down and you look at more information, traders will look at, the peaks, the highs and the lows, and come up with a story about, a potential trade. So in this particular stock, the trade I've been watching is basically just a little head and shoulders pattern, here on the hourly chart. You have symmetry here. You have a peak high, which is the head, and you have left and right shoulders, which are about the same height. That's what I mean by symmetry. And you have a flat bottom support right around 568, 569. In this area, you can see buyers have stepped in. So the trade really here to me is, a clear break of support with volume increasing, which tells me the stock could potentially be setting up for lower prices in the near term. Now, what else I mean by this story is understanding the risks. Well, when do I know when something changes? In this particular instance, this story says this stock, I can anticipate potentially lower prices. However, if that doesn't happen, I know that above and beyond this pivot high right here at 578, if the stock were to get through this level, that story has potentially changed and something is changing. So when we talk about the story, it's really understanding the risk as well as the reward of what you're looking at.
Well, Inwood123 has one for you. He wants to talk Las Vegas Sands. He says, I see the 8-day moving average positioning to cross the 21 from under. Is this a possible Evan Laz catch play?
Let's look at LVS. I don't see it. It doesn't look like a catch to me. Again, the 21 is the most important moving average that I look at. It really defines the intermediate term trend. The intermediate term trend here in LVS is clearly down. Right? There's nothing about this that tells me that you need to be a buyer or want to be a buyer. There's always going to be the bottom pickers. There's always going to be the traders that are trying to figure out where the bottom is. It's not the smart trade until something dramatically changes. And unfortunately, I just don't see it here. Like Scott mentioned earlier, casinos, you don't really see a whole lot of money flow there. You don't see any pent-up energy. Again, talking about the story, we can look at smaller time frames. Here's an hourly. There's no real reversal pattern building in here. I think it found a short-term low. It's correcting. Could there be one more, minor up move for a correction? There could be, but it's still not a trade that I would throw a whole lot of money into the long side. When you have moving averages that are pointing down like this, it's not the kind of thing you want to be long. Just like when you have moving averages pointing up like this, you don't want to be short. At some point, there will be a change, but you don't need to be the first trader there, to figure that out. The first trader rarely ever makes the money.
Well, this is a good follow-up then to that point. Mr. Uno, Laz, how do you control all of your impulses when you trade?
How do I control my impulses when I trade? If you're a day, and again, I think this is a question really about day trading. I think day traders, conditionally are more impulsive. They see these quick up moves, and today's a great example of that, of what happened in the market in the last, hour or so. How do I control my impulses? I basically say to myself, what choice do I have? You don't have a choice. If you're trading on impulse, it means you're trading on, a feeling, and feelings can't really, dictate risk and reward. Feelings are all about a moment, how you feel in a specific time, and, in 10 minutes from now, that moment could very well change. So, I generally don't allow myself to trade on impulse because I am so grounded in my technicals. My technicals, and my averages and my setups and all the things that I do and look at and teach really dictate my actions. What happens in a 5-minute bar or one quick up move or one quick down move, to me doesn't dictate a good trade. What dictates a good trade is structure, patience, setup, trend, all those elements put together. That's what essentially makes traders money. If you're buying and selling because of, quick ups and quick downs and impulsive little moves, gyrations in the market, chances are you're going to do a series of, you're going to continually be in trouble. It's really the best way I can say it. It's not a healthy way to think. It's not a healthy way to perform a business. And any good trader would tell you that, failure, if you're trading on impulse, you think something's going to happen. You can't quantify your risk. You're just trading on emotion. Failure is, like I said to all my students, it's not a question of if, it's just a question of when.
Well, speaking of your students, Don Francisco also wants to know if you tutor traders. He says he could really use some help.
Do I tutor traders? Yes. I mean, to some degree, we do mentoring. I do a lot of mentoring. students come in, they go through my curriculum, the Active Trader program, and then they go into a 3-month mentoring program, online on our virtual trading floor in a private environment, with a teacher like myself or one of the other teachers here at T3 Live that really, take you through the second phase of learning. The first phase is, the concept, learning the curriculum, learning the structure, learning the foundation. The second part, after you've gone through that, is really learning, the execution, how to bridge from now saying, okay, I know this, how do I apply it? And that's really where mentoring comes in. And it is to some degree, it's tutoring. I try and take the approach of, I teach traders how to fish versus trying to catch them a fish. The program is built so that it's designed to teach you how to think about, all the things I talk about, controlling your impulses and structure and, form and setups and risk and all, putting that whole puzzle together so that you can figure out, what is a good trade.
Well, DBQ wants to know, Laz, how many hours do you work per day and how many hours do you sleep?
I'm up at 6. I'm generally here by 7:30. I work till about, depending on what's going on, somewhere between 4:30 and 6. I go home, I spend a couple hours with my wife and son, read a few books to my boy, put him to bed. I'm in bed by 11:30, up again at 6. It's a nice life.
All right, well, coming up, we're going to be joined by both Laz and Red Dog. We have to take a quick commercial break first, though, so we'll be right back.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders to understand how to develop an edge in the markets so you can put your money to work with confidence. The T3 Live approach includes a mix of training, trading, and technology to help you learn to recognize, adapt, and ultimately take advantage of different market conditions. So what actually separates T3 Live from other educational firms? For one, transparency. We show all of our positions live, so there's no smoke and mirrors. Basically, we put our money where our mouth is. We have to because we're regulated by the SEC and the Chicago Board of Exchange. Number two, we're real traders. You'll be learning from real professional traders that make a living trading their own proprietary trading accounts, not just instructors that don't trade. Your goal should be to associate and learn from big traders who can teach you how to take your trading to the next level. And three, credibility. Millions of people turn to places like CNBC, Wall Street Journal, Fox Business News, and these outlets actually look to T3 Live for information. No other educational firms are asked to be a consistent contributor. We at T3 Live would like to get you started with a step-by-step method that has been proven over time. The same blueprint for success that I've gone through. It's not a weekend seminar, it's an approach, a mindset, a process to show you how to take control of your financial future. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our Foundation 30-day online home study course. The reason I'm willing to give you such a valuable course for free is I'm sure that once you complete the program, you'll want to continue your education with our team. All you have to do is fill in your name, email address, and I'll see you on the other side.
Welcome back, guys. We're answering your questions live. I'm joined by Scott Redler and Evan Lazarus. Going to offer two different perspectives. Everybody has a different style, so we're going to take a look at theirs. Let's start with a question about Morgan Stanley from Market Picker, saying MS is forming a wedge pattern. Do you think this has the potential for a nice trade, or simply a means to bait in longs for a false breakout?
Well, Morgan Stanley out of the whole group has been the one that's been leading them lower. And just like timing the market and just like taking the one man's trash for another's treasure or vice versa, there's a difference between a tactical long and there's a difference between something that you could hold. And for Morgan Stanley and some of these other banks, I just think that there's a tactical cash flow trade there. They're not something that you need to sustain or have any size within. This morning on the price point sheet, I actually listed Bank of America, and I talked about Morgan Stanley because this pattern was actually pretty clear. And all you could ask for is a tight pattern that you could trade and have your risk with. So if you look at the chart of Morgan Stanley, you will see that you go to the chart here, it's very tight, right? There were a lot of other exits here. You look at Morgan Stanley, if you were long it and when it broke this key support, this was your exit, and then it kind of flagged again, had no strength, no power at all. went lower, and then you had your low that was put in back on like what 6.4, 6.5, and then since then it's held a bit higher. So do I think it's going to get to 17 or back to 21? Not really. Do I think you can make a cash flow trade if the market wants to continue tomorrow? Yeah. So if that's what you're looking to do, Morgan Stanley above 1420. I think you play for some cash flow. Maybe it comes up and tries to fill this gap right into this area, and this would be a very frisky move by Morgan Stanley. I think short term for the easy trade, I would say be thankful if you can get 1470. So this would be your entry. So we talked tier system. This would be like tier 1 if you're a Morgan Stanley fan. Within this range, say I'm going to hold it versus low. Your tier 2 as it goes in motion is if we get some strength in the banks and it clears it, because if you're short Morgan Stanley, you're probably going to want to cover it considering where it came from. And if you're looking for a tactical follow through to the upside, here you go. And just real quickly, because I saw this morning, very similar pattern, looks very similar to Morgan Stanley, is this Bank of America where I put a low in. It's got a bit of a wedge pattern here, so there is some type of entry. If this can get above 777, or this peak here is 790, you could see some type of cash flow move to retest $8, or if the market does get really, really, really frisky, you could see something into the 8s, but I think having your objective lined out realistically, where you're not expecting for a move back to 10, because I think that's well out and not on the cards. This is your tactical entry, and at least you have your risk defined and potential outcomes.
Laz, anything you want to add to Morgan Stanley or Bank of America, or agree?
No, frisky. I can't top frisky. Frisky is, but I agree with Scott. I think these trades, they're catch plays. This is, again, active trader strategy. Rising 8s, flat averages. They could be good for 1 to 3 day type of trade. I wouldn't put a whole lot of risk into them, nor would I put a whole lot of time or effort into them. But they could be good, short-term cash flow trades. Yeah.
Okay. Well, here's another direct for you, Laz. What do you think of ConocoPhillips here?
Let's take a look. I'll give you my my 2 cents. Let me look. ConocoPhillips, it's okay. It's starting to build a base. Your averages have gone bullish here, sitting below the 200 EMA, which is this black line. Again, it's one of the trades where you definitely had some damage done. Found a bottom here at 51, trying to retrace some of this downside. So let's throw up some fibs here. Just take a look at where we are. Again, there could be some upside. You could get back to the 618, the prior pivot high at like 50, just in the 56, 57 area. But at 55, you got to look at your risk reward. What are you risking here? Probably, $1.50 on the downside to make maybe $2 on the upside. I don't love that risk reward. I'd keep an eye on how these averages, if they push the stock higher, it kind of is caught here. I would even consider going up a time frame, look at a larger, perspective. Here's a weekly. Again, this isn't a great long. You have a flat 21 here. The stock really hasn't gone anywhere for the better part of since October. We saw a move to 60 and a move back to 50. I don't know if I would be putting a lot of time or effort again or capital into this trade. There could be a cash flow trade here, in a couple of days. But like I said, risking about $1.50 to make maybe $2, not a great setup.
All right, Scott, why don't you take this one from iWild, saying when you see a spike like we got this afternoon, do you short those quickly or do you watch and see what develops?
I think there were a few ways to trade today's spike into that news. One, you needed to be prepared. So those who knew the range of the spiders or the diamonds over the course of the last 4 days knew when we got that type of news, because the market was looking for some type of bazooka or coordinated effort, you could see a big spike, shorts cover, make cash flow money. The same way if you knew where resistance was, you could have shorted that emotion. So the real question was, will it hold higher? Could you see commitment to it? So if you look at the chart of the spiders, let's go to this situation here. Let's go to the 13-minute. So you could see, what happened there, because you have a few days. Let's actually go a little bit further. Let's go to the 34, where you'll see this range. Okay, we've been in this range that has been driving people nuts ever since that gap up, where you have the low support side 131. You had this outlier day, okay, that was sold. So really, this was your other key area to watch. So knowing that on the spiders, 133.30 would give you a quick squeeze for cash flow, you were armed with it. And actually the news came out and you had about 30 seconds or 20 seconds to buy the spiders and the diamonds. I went with the diamonds because spiders are going ex-dividend, so if I was going to hold something, I wanted to be in there. But anyway, there was a quick trade there. And then I actually even think my buddy over here, Laz, knew that 134.29 was that prior spike, where we failed from. So he went short, saying we just came from here, look, or actually, sorry, this area, it's probably going to be reactionary. I wanted to prove, and he shorted 134. So I was buying this, selling into that, knowing it was resistance, and he was probably shorting that, saying, you know what, I'm going to give it, let it beat me and cross that. So you could have actually made money in both ways of the trade. And then really at the end of the day was when, the last 10 minutes, a lot of people were still trapped. A lot of people who were a little bit stubborn were probably fighting it. You go a little bit closer to just say the 3-minute chart, we'll go just to today, and you will see that after, it was pretty whippy. After it cleared this and gave you a nice move, you had this little wedge type pattern, and it failed. So you didn't even have to anticipate into that 134. You could have watched the action here, and once it started to break back below that pivot, because remember we were watching it, you could have made quick money, and then it regrouped and closed pretty much above it. So that's why I went home a little long, not huge, but I took the diamonds because you have a very similar pattern in the diamonds, and actually that was a little stronger today. So if you knew that this was resistance, you had some money, but you had to really know your levels. So if you're a tactical trader and you're trading very short time frames, you have to have a lot of different charts up. So this would have made sense to have your 3-minute daily chart up, and also your 15 or your 30-minute 5-day chart, so you knew where that range was, where you knew where shorts that were uncommitted would cover, and where potentially you could fade against in order to make quick cash flow.
Laz, do you have any different strategy from that?
No, I mean, Scott's right. I think it's really this is a day trader, this is a day trader special. For somebody that's trying to maneuver the market with longer term horizons, it definitely makes trading a little more, tenuous. If you look at the daily, this is a tough environment. Red, green, red, green, red, green, red, green. It's a tug of war. Every day is a tug of war. And traders are, like Scott said, I think the word's tactical. Knowing your levels, knowing where you want to be and why is really the difference between, being able to maneuver a tape like this and just throwing your hands up in the air and saying, I give up. This is really what makes, this is the difference essentially, why some traders fail and some traders succeed. It's really, putting your practices into application. So whether you're on the short side or the long side, it's not necessarily a question of wrong or right. It's understanding why you're doing what you're doing. And I think that's really, at the end of the day, that's what separates, some traders from other traders. And, this market's, it's a struggle. The averages on the hourly are still up. It still, speaks to potentially higher prices. But there's a lot of volatility from day to day to day, not to mention gaps. So, being flat, for me personally, coming in flat, having no expectations, being neutral to the market, letting the ebbs and flows sort of play itself out, and tactically stepping in at key levels, whether it's prior support, prior resistance, at the averages, whatever it may be, before something changes. I am keeping an eye on what should act as more significant resistance, which is really in this area. You can see that's where we tailed down from. This is really where the market held, the S&Ps. This is the diamonds, but it looks the same on the S&Ps. So we'll see. I think it's still a tug of war. We call this trade the frog in the blender trade, red, green, red, green. I know that's a little graphic and disturbing, but
Frog in the blender.
But that's,
Who calls it that?
Settle down, Frisky. That's a very tough. It's a very tough tape to navigate unless you're just minimizing your expectations and trading at specific key support resistance levels when and if they present themselves.
Now, when using the spiders as a hedge against your longs or shorts, how do you determine your hedge size? That comes from Ken's chart.
Well, it all depends on how directional you want to be. And if you think that we're going to head higher and you're holding 7 to 8 positions right now, you probably need to have a decent sized hedge in the spiders. Maybe you go a third, of your equity. So if you're long 10 million, you'd be short 3 million spiders. If you're long $100,000, you'd be long 30,000. So this way, if you did get some type of move lower, you could then cover your spiders, and hopefully you're in strong stocks that at least fill the gaps, give you a way out, and then have a continuation. If you don't want as much market risk or direction risk, and you think that your stocks alone will give you a higher beta or an alpha, then maybe if you're long $500,000 worth of stock, be short $400,000 worth of spiders. So this way you have the alpha if you're in high beta, and you're a little bit more hedged and you can keep your positions. But right now this is day one out of that potential tight pattern. So I would think people who want to be long are probably going to be a little bit more directional versus having positions and just taking away the upside by having a big hedge on.
All right. Les, anything to add?
No.
Scott, here's one for you. Do you ever use tick charts? If you do, what do you look for? That comes from Ron.
Do I ever use tick charts? No. I use candlestick charts. And I create my daily game plan from daily charts, and then once the day starts to go, I have 4 or 5 different intraday charts. You know, like I said before, sometimes it's a 5-day, 15 or 30 minute. Some days like a 3-day, 5-minute, 2-day, 2 minutes. So I line up all the time frames. So this way, when I want to make a bigger bet, you know, more time frames are aligning than just an intraday chart or just a daily price point.
All right, let's get ready to look ahead to the weekend and into next week. We have one from Inwood123 saying, if markets are pricing in a positive Sunday in Greece, would this be a pop on Monday? And fade the news.
That's like sort of similar to the other question. It all depends on how we close tomorrow and where we go to. So, you know, instead, like last weekend, everybody on the Twitter sphere was trying to handicap, oh, how many handles are we going to open up? You know, are we going to be up 15 handles? Are we going to be up 30 handles? Where are we going to be in the morning? You know what? Sunday's Father's Day. You're better off enjoying yourself and your family, your friends, and having some fun. You know, the market will be there on Monday. So what you want to do is you want to say, what type of risk do I want to take into the weekend, you know, depending on where we close? And could you handle it if you're wrong? So I talked on the chat room today in the virtual trade floor saying that if you think we're going higher, then what I would do is I would take more like in the money calls. So at least your risk is premium paid. You know, if you're not willing to be committed to your stock. So this way, if you're wrong, you know what your risk is. Same way if you're looking to be short, you know, don't be just shorting stocks, shorting spiders, shorting diamonds, because if you're wrong, you know, it could be very hurtful, and who knows, maybe they blow through resistance areas. So if you're not committed, I would say use options for premium paid. And then, you know, if you're going to trade and go into the weekend flat, you know, if we gap up into, like Laz said, just say you look at the SPX here, we gap up into this, you know, remember that head and shoulders pattern, so to speak, right there. That was your neckline. This was some congestion. So if we would be gapping up into this 1355-ish, or even as high as this area we broke down from 1367, this would be your zone to fade. Because typically the first time you get there would probably be more of a short than chasing long excitement if we gap up 25 handles. Same way if we're down, you know, from here down to the, you know, to the support 20 handles, or we're down to this area, you know, you probably need to figure it out, give it 30 minutes to pan out, and maybe you're a buyer. So the beauty of day trading is it's tactical. You know, you try and shorten up open. If they don't pull them in, you buy them. If they open lower, you try and buy them. And if they can't bounce, you get out and you potentially short them for downside. And so this way you could have your tactical cash flow rules, and then if you're an intermediate or macro position trader, you then at least have defined risk by taking options versus, you know, balls to the wall stock in either direction into what could be a crazy Sunday.
Now, based then on what you said, is it safe to say that you would not hold any short into the weekend? We had one from Birdie JC asking if you would hold anything short into the weekend, even stocks like Lulu and Nike, which we talked about before.
Well, a stock like Lulu and Nike that's basically broken, that has broke uptrends at the 200-day, it all depends also how we close tomorrow. You know, so we'll see. If we get, just say we're up another 10, 15 handles tomorrow into the weekend, you know, right now I'm net long. I'll probably sell into that and probably have a little less because we'll be near resistance. If all of a sudden I like the way 8, 9, 10 stocks look tomorrow, which I probably won't, you know, then I would probably be more short. So I think if you're short or you're going directional tomorrow, make sure, I think it's with options, not with stocks, because again, anything can happen, and there's no reason to put yourself out there into that type of risk.
Laz, your game plan heading into the weekend?
I'm going to go with Scott's first answer. I'm going to enjoy my weekend. I'm going to take no risk over the weekend. I just don't, you know, I'm a big believer in understanding your risk. That's how traders make money. If you can't quantify the risk and you're just throwing a dart against the wall and saying, well, I hope I get this big gap up, or I hope this, or I hope that, you shouldn't be in a trade.
All right, well, speaking of risk versus reward, Market Picker says, do you think Ryder is a good short with a downside target down to 35-ish for a strategic trade?
You know what, I've never traded the stock, so I'll take a quick look. Let's see what goes on there. What symbol R? What's the question again? Could you read it one more time?
Sure. Do you think Ryder is a good short with a downside target down to 35-ish for a strategic trade?
Well, looking at the chart right here, there were definitely a few different areas that you could have shorted earlier. And one being when, you know, it started to break below the support right around, what was this, 48.13, and now it's trying to grasp and hold this last support area going sideways. So I would say at this point, it did reverse a little bit with the market. I would say, here's your defined resistance. It might try and bounce around. If it can't get back above 43, potentially it does break this area, and the next real level is all the way down here. But at this point, I would say Laz would probably short it into this moving average, because this is what we talk about in our active trading course, right? A rally to be sold, and right now this is technically very weak, and it does seem like it's a stock that's rallying to be sold versus something that's more investment quality.
All right. Well, I think that's all the questions that we have time for today. Laz, anything you'd like to tell the viewers before we head into the last trading session of the week?
For all my South Florida viewers, anybody in sunny South Florida, T3 Live's hosting an Active Trader Summit in Boca this Saturday from 9 a.m. to 5 p.m. All the details are on our website. For those of you that want to do some networking, meet some traders, and talk some shop, it's going to be a great day. And additionally, check your email this weekend, because we are doing a Father's Day promotion.
Yeah, I was going to say Father's Day Sunday. I know we talked about trying to put out some kind of promotion for those of you who are watching, those of you who are into lifestyle, those of you who want to just to be as a father, you teach your son and you teach your family fundamental do's and don'ts, right?
And it's our fundamental trading course. So, we figured we would do a little Father's Day promotion for that. So the details will be in your email box, so long as you are a subscriber or have a trial to t3live.com.
And if you are a mother and you want to get it as a gift for the father, there you go. but anyway, it's a great course, and we're gonna try and make it as price sensitive for you guys, so it's worth buying. So make sure to look at it, open it up, and see if it's for you.
All right. Hopefully we helped you guys out tonight. Meet us right here next week. Happy trading and have a great night.